Today on Real Estate Backstage, the December CPI report shows inflation is heading in the wrong direction, although markets don't seem to be too concerned. We take a look at Trump's picks for HUD, the FTC, and the Antitrust division for the DOJ. EasyKnock has announced that it's closing its doors. And finally, we'll take a look at Zillow's 2025 Consumer Housing Trends Report. Now, before we jump in, if you're watching this on YouTube or if you're listening on Apple Podcasts or Spotify, take a moment, subscribe to the show. That way you don't miss any future episodes. And if you want links to any of the articles that we're going to go over in today's show, you can find the show notes at realestatebackstage.com/episode 9. Now, I thought it would be fun for us to do a new segment called Ask Me Anything. So if you guys have questions that you'd like us to talk about on the show, any topics you're curious about you'd like us to cover, send an email to hello@realestatebackstage.com. All right, so we're going to jump in today. We're going to start with the December inflation report. So this is according to the Wall Street Journal. Quote, markets seemed undisturbed by Wednesday's inflation data, which showed consumer prices rising 2.7% in November from a year earlier, up from 2.6% in October. The data confirms an unsettling trend that inflation's decline has halted or at least stalled. Core consumer prices, excluding food and energy, rose 3.3% from a year earlier, similar to the pace at which they have been rising for several months now. Of particular concern was services inflation, which, excluding energy services, clocked in at 4.6% year over year. That doesn't seem like enough to discourage the Fed from plans to cut rates at its December meeting. As of Wednesday, futures markets were pricing in a 96% chance of that happening. Markets are betting that the gradual slowdown in hiring over the past few months makes the Fed still comfortable with some additional easing. Month-to-month swings in such factors as labor strikes and hurricanes have made the data somewhat hard to read, but the underlying trend is still clear. The 3-month average for job gains is down to 173,000 in November from 243,000 at the start of 2024, unquote. So back in September, when the Fed first started loosening up its policy, they did a 50 basis point cut to the federal funds rate, and they announced that 2 additional cuts before the end of the year, 25 basis points each, were very likely. Now, we've already seen one of those additional cuts, and we are expecting the other one this month here in December. Now, they had also forecast 4 cuts were highly likely in 2025, 25 basis points each for a total of a 1% cut. However, inflation has become increasingly stubborn since that September meeting. And so I think at this point, it is likely we're going to see that cut in December, but I don't know if we're going to get 4 cuts next year. I think maybe 2 or 3 is more likely, but it all depends on the data. So the economy has remained much more resilient than a lot of people would have expected. The labor market is softening, but it's not breaking yet. The unemployment rate has inched up a little bit. The number of new jobs being created is down, but jobless claims haven't really increased in any meaningful way yet. So that's what the Fed is really looking at. And I think as long as the economy remains fairly stable, there's going to be very little incentive for the Fed to cut rates too quickly as we move into next year. So I think they're going to tread very cautiously. All right, let's take a look at some of Trump's recent nominations. We're going to start with HUD Secretary. This is according to housingfinance.com. Quote, Scott Turner, a former Texas lawmaker and NFL player, is Donald Trump's choice to be the Secretary of the Department of Housing and Urban Development. During Trump's first term, Turner led the White House Opportunity and Revitalization Council, which aimed to enhance the coordination of federal economic development resources in opportunity zones and other distressed communities. Turner, 52, has been Chief Visionary Officer at JPI, a leading Texas-based multifamily housing developer, since 2023. He also chairs the Center for Education Opportunity at the America First Policy Institute, a think tank that features former Trump administration staffers. If confirmed, Turner would take over HUD at a time when housing affordability has emerged as a leading issue in communities across the country, unquote. So Scott Turner is an interesting pick. Of course, he was involved in the first Donald Trump administration. He did a lot of work with the Opportunity Zones, which were created as part of the 2017 Tax Cuts and Jobs Act, which incentivized investment into real estate development opportunities in underserved communities across the country. He also was a lawmaker in Texas, and he's got experience working with a multifamily developer. So this could be an interesting pick. We will see how it goes. Next, let's take a look at the Antitrust division over at the DOJ. This is one that's been getting a lot of attention. So according to Housing Wire, quote, many real estate professionals were hoping that Donald Trump's victory in the 2024 presidential election would lead to a lessening of antitrust scrutiny on the industry by the Department of Justice. But Trump's recent nomination of Gail Slater, a veterinary technology and media policy advisor, to lead the DOJ's antitrust division is casting doubt on these hopes. My gut tells me this isn't going to be a good thing for us, said Steve Murray, the co-founder of Real Trends Consulting. It may be neutral at best, which just means that everything pretty much continues. How this plays out remains to be seen as to focus on the real estate industry, but those who believe that there would be a more laissez-faire philosophy at Antitrust were certainly surprised by Ms. Slater's nomination. Chuck Kane, an attorney and the president of Alliance Solutions, added. Prior to the nomination, Slater served as a policy advisor to Vice President-elect J.D. Vance. During Trump's first presidential term, she was a technology policy advisor at the National Economic Council. Slater is known as a bit of an antitrust hawk and has previously called for Google parent company Alphabet to be broken up. Like Vance, she has praised Federal Trade Commission Chair Lina Khan for her work going after big tech under the Biden administration, unquote. So this is a bit of a controversial pick. A lot of people in our industry were hoping that with the new Trump administration, someone would be put in place at the antitrust division at the DOJ to redirect a lot of the attention, a lot of the ire that has been directed at the real estate industry toward other causes. However, it seems like with this pick, maybe that might not be the case. And unfortunately, we might see a DOJ in the Trump presidency that maintains its scrutiny on the real estate industry. All right, let's take a look at the FTC. So according to the Wall Street Journal, quote, President-elect Donald Trump on Tuesday selected Andrew Ferguson to lead the Federal Trade Commission, elevating a Republican lawyer who is likely to abandon the Biden administration's liberal approach to policing mergers while keeping the heat on big technology companies. Ferguson, one of two current GOP commissioners on the 5-member FTC, would succeed Chair Lina Khan, a progressive hero who sought to flex the commission's enforcement muscle in ways not seen in decades. She challenged a range of mergers as well as business practices by dominant companies, unquote. So with Andrew Ferguson, I expect that we would see a lot less focus on preventing these run-of-the-mill mergers and acquisitions, which probably would be good for the economy, good for consumers. It allows smaller companies to consolidate, pool resources, become more efficient so that they can compete against the bigger players. But it's likely that we're going to see continued heat on the big tech companies like Google and Facebook, et cetera. All right, a couple months ago, back on episode 1 of the show, we covered the fact that NAR was seeking to escalate its case with the DOJ all the way up to the Supreme Court. So to make a long story short, back in 2020, NAR and the DOJ entered into a settlement agreement in which the DOJ agreed to close its investigation into some of NAR's practices, namely the clear cooperation policy and the participation rule. The next year, in 2021, the DOJ backed out of that settlement agreement and sought to reopen its investigation into NAR. So NAR originally sued, and the courts originally upheld that the DOJ had to honor the settlement agreement. The DOJ appealed that, and then the appeals court sided with the DOJ, saying, yes, you can reopen your investigation. And then a couple months ago, NAR filed a petition to escalate that all the way up to the Supreme Court. Well, now the DOJ has filed a brief with their position on this appeal. According to RIS Media, quote, the Department of Justice Antitrust Division appears committed to pushing forward with a long-running investigation into National Association of Realtors policies, despite the looming transition to a new presidential administration, continuing to defend its inquiry all the way up to the Supreme Court. After sending a lawyer to speak at the final court hearing for NAR's landmark settlement deal, the DOJ yesterday filed its first brief to the nation's highest court, urging the justices to deny NAR's request that they intervene and block the investigation. While NAR previously argued that allowing the DOJ to restart the inquiry set a bad precedent and could negatively affect trust in law enforcement in the future, the DOJ referred repeatedly back to the previous appellate court ruling, which focused on the plain language of the DOJ's letter. Quote, based on the plain language and other various aspects of that agreement, the court held that the government had made no commitment to refrain from reopening the investigation in the first place, the DOJ wrote. It also spent time pushing back against some of the more technical legal arguments made by NAR, including that the agreement to close the investigation was an illusory promise, that the DOJ received favorable treatment, and that the contract issues were improperly presented to the appeals court. NAR specifically claimed that the appeals court misapplied the unmistakability principle, a precedent that states contracts should not be viewed to cede a sovereign right of the United States government unless the government unmistakably waives that right. At the highest level, NAR's appeal to the Supreme Court would appear to be a long shot, with that court only taking up a tiny fraction of appeals and mostly focusing on urgent legal questions or inconsistent rulings by lower courts. The DOJ, in its arguments, claimed that this case is a poor example of the kind of issues the Supreme Court focuses on, unquote. So, unfortunately, I think the most likely outcome here is that the Supreme Court will probably not agree to hear this case, which means that the appeals court ruling siding with the DOJ would stand, and the DOJ would be free to reopen its investigation against NAR practices. All right, well, speaking of the DOJ, we actually do have a little bit of good news this week. So the DOJ has apparently agreed to end criminal investigations into algorithmic price fixing models. So this is according to RIS Media. Quote, RealPage, a software and property management company which uses algorithms and data sharing to recommend pricing to landlords, claimed that a Department of Justice antitrust inquiry that focused broadly on algorithmic pricing practices in real estate has been closed, though it was not immediately clear how this would affect several civil lawsuits against RealPage or other investigations into those same practices. According to a statement released by RealPage last Friday, the company received notice that the Antitrust Division had closed its criminal investigation into pricing practices in the multifamily rental housing industry. In its announcement, RealPage continued to defend its practices, which include widespread sharing of pricing data among competitors, which the DOJ previously argued drove up prices, unquote. So most real estate agents have not been following this particular case very closely. It's especially true if you only do sales and you don't do any property management. But essentially, the DOJ had been investigating RealPage and a few other companies who aggregate data and use algorithms to recommend a quote-unquote fair market rental rate for a rental property. So for example, if you run an apartment building and you use one of these pieces of software to find out what is the average rent in your area for a 3-bed, 2-bath unit as a part of the decision-making process of how to price your units, the argument was that you were colluding with your competitors by using software that pulled in data from your competitors. So I'm glad to see that the DOJ is closing their investigation against RealPage. That is definitely a positive trend because by extension, this argument could be used to say that any property manager who uses software like Rentometer or Zillow rental estimates or anything like that to look at averages based on market comps was committing antitrust violations. So I think that was definitely a reach, and I'm happy to see the DOJ close that investigation. All right, shifting gears here. According to Inman, quote, sale leaseback platform EasyKnock, which faced consumer lawsuits and enforcement actions by attorneys general in several states, has closed its doors, the company announced Thursday. The news was first reported by NPR, which published a lengthy investigative piece on the New York-based sale leaseback platform's business practices in June. Last month, the Connecticut Attorney General's office filed suit against EasyKnock, alleging the company, quote, targets cash-strapped homeowners in need of financing who, for reasons of poor credit or excessive debt, may not qualify for financing. The November 27th complaint, which detailed 3 instances in which cash proceeds allegedly equaled just a fraction of the consumer's total home equity, and accused EasyKnock of engaging in illegal practices as a landlord, sought to stop the company from doing business in Connecticut, as well as restitution and civil penalties. NPR documented consumer lawsuits against EasyKnock in Texas, Maryland, South Carolina, Pennsylvania, and Ohio, and enforcement actions by attorneys general in Michigan and Massachusetts. Last year, EasyKnock announced a deal to acquire power buyer Ribbon and launch a national marketplace, followed by a $28 million Series D funding round in February, with Northwestern Mutual Future Ventures joining existing investors, unquote. So EasyKnock was one of those sell-before-you-buy platforms for homeowners that had a home they needed to sell in order to qualify for the purchase of their next home. But rather than go through the traditional option of finding a property they like, making an offer contingent on the sale of their other home, instead, they went ahead and sold their home to EasyKnock and leased it back from them for a certain period of time. Now, the use case here would be, maybe you're in a tough market and you don't want to make your offer contingent on the sale. You want to be a cash buyer or just a buyer who doesn't have that contingency. Maybe you felt like you wouldn't be able to sell your home in the traditional way. Maybe it needed significant repairs or things like that. Now, apparently, EasyKnock was engaged in some pretty unscrupulous business practices here. They've been accused of predatory lending, targeting people that were in desperate need and maybe treating them unfairly. And apparently, they were also violating Landlord-Tenant Act in several of these states, because keep in mind, when you do the sale leaseback and you sell your property to EasyKnock, then they become the landlord and you're the tenant, and you're renting back your old house from them for a certain period of time. And if they're doing this in multiple states, they have to make sure that they're complying with landlord-tenant law in all of those states. All right, so I want to wrap things up by going over this report from Zillow. It is their 2025 Consumer Housing Trends Report. I believe this came out in October, and I've been meaning to get to it for the last several weeks, but we've just had so many other things to cover. I'm going to go ahead and put the PDF up on the screen for you guys, and we will take a look at it together, and we'll just kind of go through the parts that I feel are most relevant. All right, they call this the 2025 Consumer Housing Trends Report. It sounds like it's forward-looking, like it's a forecast, but in reality, this is based on surveys they conducted with people who bought or sold in 2024. So don't let the name fool you. This is kind of a backward-looking what happened this year, not what they expect to happen next year. All right, let's skip ahead to section 2, buyer preferences. So the first one here, how many agents do buyers contact? So the key takeaway here is that recent buyers who contacted an agent didn't shop around much before hiring. 71% only approached 1 or 2 agents before deciding whom to work with, and 47% hired the first agent they contacted. So they broke this down and compared first-time home buyers with repeat buyers. Overall, across the board, 47% of buyers in 2024 only contacted 1 agent. For first-time home buyers, that was a little bit lower, 40%. For repeat buyers, it was 52%. But the key takeaway here is that almost half of buyers will only consider 1 option. So I tell my agents here at Bluefield all the time, especially when you're working with internet leads, if at all possible, you want to be the first agent they talk with. You definitely want to be the first agent they meet with face-to-face. Almost half of buyers in 2024 only considered 1 real estate agent. They worked with the first person they talked with or the first person that they met. A lot of agents will talk to a lead on the phone. They'll ask a lot of the right questions. They'll get information, but they won't ask for an appointment. They won't schedule time to meet face-to-face. Listen, you miss 100% of the shots that you don't take. If you don't ask for the appointment, you're not going to get one. If you do ask, the worst thing that happens is they say no. But if you ask every single time you have a conversation with a lead, if they're willing to meet face-to-face, then you're going to have more appointments. That's just the way it works. All right, let's move on to how do buyers discover their agent? So in 2024, 23% of buyers found their agent online via either a website or an app. 7% found them via social network, 7% through a search engine. 22% found their agent by a referral from a friend or a family member. 5% were referred to them from another agent, presumably maybe moving from one state to another, and their real estate agent, let's say in Georgia, refers them to an agent in South Carolina. And 4% were referred to their agent by a home builder. The key takeaway here from Zillow, quote, the number of buyers relying on digital research emphasizes how important it is for agents to maintain a strong online presence. Even though a majority of buyers only contacted 1 or 2 agents before deciding who to work with, this data suggests many are conducting research online prior to reaching out. While referrals may be hard to anticipate, agents can still help themselves by keeping online profiles and social handles up to date, as well as requesting online reviews from existing clients. This is very good advice. As a real estate agent, you need to have a strong online presence. Even if you're not using these online profiles as a lead generation method, maybe you're not buying leads from Zillow or Realtor.com, or maybe you're not paying for Google pay-per-click ads or anything like that. Even if you're not relying on these online sources to generate leads for you, having a strong online presence will help you convert the leads that you get from other places. I guarantee you, if you get a referral from a friend or you meet someone at an open house or wherever you get the leads, consumers these days are checking you out online. If someone meets you at an open house or they're referred to you by a coworker, they're going to Google you. And it's important to have good profile set up with a recent professional headshot, a good description, lots of 5-star reviews. So again, even if you're not paying for internet leads, you need to have a solid internet presence because that will help you convert more of the leads that you're getting from other places. All right, so this is kind of a breakdown of all the different ways that buyers first found their agent, and it shows you the change from 2022 to 2023 and then 2024. What percent of buyers found their agent through a real estate website or app like Zillow, Realtor.com, etc.? Well, in 2022, that was 18%. In 2023, it shot up to 25%. And then in 2024, came back down a little bit to 23%. What percentage of buyers found their agent through a social networking website or app like Facebook, Instagram, TikTok, etc.? In 2022, that was 5%. In 2023, it jumped up to 8%. And then in 2024, it receded a little bit down to 7%. Now, what about on a search engine? Like you go to Google and you type in real estate agents in my area. In 2022, 5%. In 2023, bumped up to 7%. And in 2024, held steady, 7%. All right, what about the various referral sources? So referral from a friend, relative, neighbor, or colleague. In 2022, that was 21%. In 2023, that number actually dropped to 18%. And in 2024, it came back up to 22%. Referral from another agent or broker, that's fallen the last couple of years. So it started in 2022 at 7%, and then 6%, and then 5% in 2024. So the percentage of buyers that are getting connected with their agent through a referral from another real estate agent has been dropping steadily the last couple of years. Referral from a builder went from 3% up to 5% and back down to 4%. All right, what about community? So what percentage of buyers found their agent because they already knew them from the community? Maybe they had a good brand, they sponsor the local swim team, they've got their their branding on the bench at the bus stop, they're in the magazines, they volunteer at the PTA, they serve on the HOA board, that type of thing. Well, in 2022, that was 12%. In 2023, that fell all the way down to 6%. It got cut in half, but it has come back up a little bit, up to 8%. So knowing them from my community, you already know who they are based on their involvement in the community, that is 8%. Past experience with this agent or broker, that has held very steady at 8% year after year after year. So from 2022, 2023, and 2024, 8% of buyers are working with an agent because they worked with them before. That is a pretty darn low percentage. All right, what percentage of buyers got connected with their agent because they saw their contact info on a for sale or an open house sign? That has been growing, but it's still a pretty low percentage overall. So in 2022, that was 4% of buyers. In 2023, it was 5%. And then this year in 2024, that's come up to 6%. So 6% of buyers are finding their agent based on their information on a for sale sign or an open house sign. All right, what about open houses? This one is held fairly steady as well. So in 2022, it was 5%, 2023 dropped to 4%, and then in 2024, back up to 5%. So 5% of buyers met the agent they worked with at an open house. All right, direct mail, this has declined a little bit. This is definitely the smallest piece of the pie here. So this is newsletters, flyers, postcards, etc. In 2022 and in 2023, that was 3%, but this year in 2024, that's fallen down to only 2%. And then this other category has gone from 9% to 7% down to 4%. So the key takeaways here. So what have been the biggest changes? So the biggest changes from what I see is a real estate website or app. So that would be like Zillow, Realtor.com, etc. That's gone from 18% 2 years ago to 23% this year. That's a pretty big jump. Know them from my community. That's probably been the biggest decline, from 12% down to 8% over the last couple years. All right, why don't some buyers use an agent? So according to the report, quote, the overwhelming majority of buyers, 85% that we surveyed, used an agent. Among the small share of buyers who completed a transaction without an agent, 42% of them said they already knew the seller personally, 36% did not want to pay a commission, and another reason, 11% had a negative experience with an agent in the past. So 42% of the time when a buyer did not use a real estate agent in their transaction, it was because they already knew the seller personally. Maybe it was a family member, a friend, a coworker, a neighbor, and they felt like, hey, I know this person, I trust this person, I don't need an agent involved. 36% of the time when a buyer did not use an agent is because they did not want to pay a commission. So they probably had it set in their mind that if I don't use an agent, I'm going to save money, even though the studies tend to show that that is not true. A good real estate agent is going to negotiate for the seller to pay their commission, most or all of it, and they're also going to help negotiate a better price, better terms, more repairs, things like that. And finally, 11% of the time, it was because they had a negative experience with an agent in the past. To me, this is kind of silly. That's like if you had a bad experience dating someone, you just say, I'm never going to date anyone ever again. All right, moving on. Let's take a look at this one. Do agents benefit from being active on social media, to TikTok or not to TikTok? So from the report, quote, that might seem like a silly question, but we often hear agents ask about the effectiveness of social media. Since 7% of buyers who used an agent first discovered the person they wound up hiring on a social network, it makes sense to consider the broader impact of these platforms. So let's look at the actual data, how an agent's social media activity impacted the chances a prospective buyer would hire them. So 46% of people said it would have absolutely no impact, and 44% said the buyer would be more likely to hire an agent who's active on social media, but 10% said it would actually make them less likely to hire an agent that's active on social media. How do buyers prefer to communicate? When it comes to communicating, 53% of buyers who worked with an agent preferred to text or use a messenger app, while only 33% wanted to speak on the phone. When you add in buyers who liked sending email, 13%, 2/3 preferred written communication with their agent over a traditional phone call. And of course, as you would expect, this is kind of broken out among generational preferences. So, of course, the Gen Z generation was the most likely to prefer text message or a messaging app. And as you get into the older demographics, this tends to become less likely. And the opposite, of course, is true with phone calls. Gen Z was the least likely to prefer a phone call as their top method of communication. And as you get into millennials, Gen X, and then baby boomers, you see a higher and higher percentage of the clients preferring phone calls. So what this means is you need to be tailoring your communication style to your clients. But don't just make an assumption. Don't just assume because you're dealing with a baby boomer that they want a phone call, or just because you're dealing with a Gen Z, they want to do, messenger app or something like that. I think it's important to ask your clients what is their preferred method of communication and just be flexible. If they want phone calls, then do phone calls. If a text is more convenient or if an email is more convenient for them, tailor your communication preferences based on what that particular buyer wants. Don't just approach it as a one-size-fits-all solution. All right, so I found this one pretty interesting. Do buyers find agent commissions fair? So this is especially important in light of the recent lawsuit and the settlement that's been in the news a lot lately. 70% of buyers thought that the amount of commission their agent earned was fair. Only 21% thought it was too high, and 9% actually thought that it was too low. All right, let's skip ahead over to seller preferences. All right, why do sellers list their homes? So 78% of the time, the sellers were influenced to sell by at least one major life event. Quote, the most common factor impacting 51% of sellers was a change in household or family size. So think getting married, getting divorced, having a kid moving out, going to college. Change in household size is the number one driving factor behind why someone sells a home. So the moral of the story here is that you need to stay in touch with your database, your sphere of influence, your past clients. You need to understand what's going on in their life. Maybe you're friends with them on social media. Maybe you check in with them every once in a while, but when you see online or when you hear during a conversation that there's some type of major life event that either recently happened or is coming up, that could be a good segue into a discussion about their real estate needs. All right, how many agents do sellers contact? Sellers who worked with an agent were more likely to hire the first person they contacted, 59%, compared to buyers, 47%. The difference is even more drastic among first-time sellers, 64% compared to first-time buyers, 40%. Urgency could play a big role here, especially among sellers influenced by disruptive life events like a job transfer. So this is really interesting to me. I feel like this is a change. I'm going to have to go back and see if I can find the data I'm thinking of, but I seem to remember reading at some point that sellers were more likely to interview multiple agents than buyers were, but apparently that's not the case anymore in 2024. So it seems like buyers are actually doing a little bit more due diligence, meeting with more agents before making a decision than sellers are. Sellers, 59% of the time, work with the first agent that they contact. Again, this goes back to getting in front of the lead as soon as possible. A phone call is great, but you want to do a listing appointment. Even if they're not planning to sell for another 4 months, 6 months, I recommend getting out to the property, meeting that potential client face-to-face, because the vast majority of sellers will work with the first agent that they interact with. However, that doesn't mean that you should just assume that you've got it in the bag. Never take a listing appointment for granted. Just because you meet with someone, don't assume that you're the only one they're going to meet with or that they're only going to meet with maybe you and one other agent. You should always approach a listing appointment, even with a repeat client, as if you were competing for their business against 5 other agents. You got to bring your A game to these listing appointments no matter what. How do sellers discover their agent? The most popular way sellers first come across the agent they hired was through a real estate website or app. That slightly edged out referrals from a friend, relative, neighbor, or colleague. Since 2018, the first year we tracked this question, the share of sellers who found their agent online has jumped from 15% to 36%. Meanwhile, the share of sellers who discovered their agent through any type of referral dipped slightly from 31% down to 28%. All right, and we can see the breakdown here from year to year, 2022, 2023, 2024, where sellers found their agent. So the share of sellers who found their agent that they ended up working with on a real estate website or app has gone from 20% in 2022 up to 27% in 2023, and then back down to 22% this year. Social media was 6% in both 2022 and 2023, and then it bumped up a little bit to 7% in 2024. Search engine, this has grown fairly significantly, so 4% in 2022, and then 6% last year, and then 7% this year. Referral from a friend, relative, neighbor, or colleague, 18% in 2022 and 2023, and then up slightly to 19% this year. Referral from another agent, down slightly from 5% to 4%. Referral from a home builder actually up slightly from 3% to 4%. All right, I know them from my community, so that's dipped slightly from 12% 2 years ago to 11% this year. Past experience with this agent, this has dropped significantly over the past couple of years. So in 2022, 15% of sellers were working with an agent that they had worked with before. Then that dropped to 11%, and then this year that's all the way down to 8%. So big change there. Open house, that's held pretty consistently at 5%. A lot of people think open houses are only for buyer leads, but a lot of times you can get some really good seller leads from open houses. And not just because most buyers are also sellers, but you're going to get some people in the neighborhood who are thinking about selling within the next 3 months, 6 months, 12 months. They see an open house down the road and they're just curious about what's going on in their neighborhood, maybe what their competition would be. And so you'll get a lot of nosy neighbors sometimes that walk through the open houses, and don't write them off just because they live in the neighborhood and they have no intention to buy right now. Maybe they're thinking about selling and moving out of state in 6 months. So that could be a great listing opportunity. All right, what qualities do sellers value most in agents? So 75% of sellers said that finding an agent with a positive reputation in the community was highly important. Local market knowledge is crucial, a strong sales history is key, and a positive reputation in the community helps a lot. But what sellers want most from their agent is someone trustworthy and responsive. Since most sellers hired the first person they contacted, many agents seem to be conveying these traits to their clients. Only 55% of sellers who worked with an agent said finding someone who charged a lower commission or offered a rebate was highly important. That ranked last among all the agent characteristics in our survey, end quote. So that is very encouraging to me. Sellers are less concerned about just finding the cheapest option. They want the best option. That's encouraging. All right, y'all, that's a wrap for today. Just a reminder, you can find the show notes with links to all the articles we referenced at realestatebackstage.com/episode 9. I'll see you here next week with another behind the scenes look at the real estate industry here on Real Estate Backstage.